Ever looked at a business, maybe one you're thinking of investing in, or, even the one you work for, and felt totally lost, trying to figure out its real worth from all the different reports and news articles out there?
Yeah, it can feel like trying to solve a puzzle with like way too many pieces.
Exactly. Well, today we're grabbing those pieces and diving deep into the core of business valuation.
Right. And we're using Marco Fazzini's business valuation theory and practice as our guide for this deep dive.
Yeah.
Think of it as your shortcut to understanding what really makes a business tick, financially speaking, and how its potential value is, well, figured out.
Yeah, our mission is pretty straightforward.
Mm.
Pull out the most important ideas, the methods of business valuation, and explain them in a way that's, clear, engaging, and hopefully cuts through some of that complexity.
We're not aiming to turn you into a valuation expert overnight, obviously.
No, definitely not. But to give you a solid grasp of the fundamentals without getting totally bogged down in, endless spreadsheets.
And Fazzini's work really gives us a comprehensive view. It covers everything from looking at a company's past performance, things like its debts, profits, EBITDA, to understanding its place in the market and exploring different ways to actually put a number on it, whether that's by looking at future income, comparing it to similar businesses, or even considering the cost of its assets.
And we'll touch on valuing those invisible things, too, like brand reputation.
Exactly. And things like premiums and discounts, too, yeah.
Okay, so let's get right into it then. What is business valuation like at its core?
Well, simply put, it's the process of estimating what a company is potentially worth. But it's definitely not just about crunching numbers.
Right.
It's about looking at a mix of what's happening inside the company. Its debt compared to its equity, its earnings, its revenue, the cash it generates. Those tell us a lot about its financial health, its track record.
So it's like taking the company's vital signs, kind of. But we all know a healthy inside doesn't always mean success if the environment is tough.
Precisely. That's where the external factors come in. You absolutely have to consider the market it operates in. Is it growing? Shrinking? Who are the competitors? How strong are they?
How does it actually reach its customers?
Yeah.
Distribution channels and all that.
Yes. And crucially, what do customers actually want? Tastes change. So a good valuation connects the dots between the company's internal mechanics and the realities of the outside world.
That makes a lot of sense. It's not just the internal score, it's how that score plays out in the real game.
Fazzini uses a helpful analogy, doesn't he? Comparing valuers to photographers.
He does, yeah. He points out that to get a good picture, a photographer needs the right gear, the right setting, and, the skill to use them properly.
Okay.
Similarly, in valuation, you need the right models, that's your camera, and you need to know how to apply them correctly. That's the skill to get a clear, accurate estimate of value.
And just like a photographer wouldn't use, a wide-angle lens for every single shot, there isn't one single way to value every business, is there? Yeah. Exactly right. The International Valuation Standards, the IVS, they stress this. You need to pick the method or methods that are most suitable for that specific situation.
Different lenses for different views.
Pretty much. You can look at value through different lenses. Income-based methods, they focus on the money it's expected to make in the future. Market-based methods look at what similar companies are selling for. And cost-based methods consider, well, what it would cost to recreate the business.
Each gives a different perspective.
Totally. And no single one works universally.
Okay, so we have value, what a business could be worth, its potentiality, and then there's price, what someone actually pays for it right now. Are those always the same?
Oh, absolutely not. Often there's a real gap between that potential value and the actual price paid in a deal.
Why is that?
Well, value is more about the inherent worth, the future potential. Price is what happens in a specific transaction at a specific moment, driven by buyer and seller motivations and negotiations.
So both can be justified.
Yeah, potentially, depending on the context. Oscar Wilde had that great line, didn't he? Nowadays, people know the price of everything and the value of nothing.
Yeah, good one.
It really highlights that price isn't always a true reflection of the underlying value. Think about market bubbles, right? Sentiment can push prices way above what the fundamentals suggest.
That's a great point about market psychology playing a role. Fazzini also mentions different bases of value from the IVS. Can you give us a quick rundown?
Sure. The IVS outlines several ways to think about value depending on why you're valuing it. Market value is probably the most common one.
Right.
It's the estimated price a willing buyer pays a willing seller, assuming they're both informed, not under pressure, and it's marketed properly. And crucially, assuming the asset's used in its highest and best use.
Okay. What else?
Then you have things like market rent for properties, equitable value, which is about fairness between specific parties, investment value or worth. That's the value to a particular investor based on their unique perspective or plans.
Like if they see synergies?
Exactly. That leads to synergistic value,
Yeah.
the extra value from combining businesses. And then there's liquidation value, which is what you'd get if the business had to be shut down and assets sold off, either orderly or in a forced sale.
So there's this objective underlying value idea, but also this subjective element depending on who's involved. How should valuers handle that?
It's a balance. While there's always some subjectivity, a valuer's main job is to focus on the objective side. They need to use established, generally accepted methods to figure out that intrinsic value in an efficient market.
Stick to the methods.
Right. The subjective stuff, individual motivations, perceptions, they exist, but the valuer needs to ground their analysis in objective techniques as much as possible.
You mentioned earlier that different methods look at different time horizons. Can you expand on that?
Yeah, sure. Cost-based methods are very much about the present. What would it cost to replace the assets right now?
Okay.
Income-based methods like the discounted cash flow or DCF, they're all about the future, predicting future cash flows and discounting them back.
And market-based.
Market-based methods look sideways, you can say, comparing the company to similar businesses that have recently been bought or sold to get a feel for its current market price.
Present, future, sideways. Got it. Okay, so we understand the what and the different angles. Now, who actually uses these valuations? And why do they need them?
Oh, lots of different reasons, which leads to different types of valuation work. You've got third-party valuations. These are independent, in-depth analyses often needed for M&A, for buying or selling a company.
Sell side versus buy side.
Exactly. A sell-side valuation helps the seller know what their business is worth. A buy-side one helps a potential buyer figure out if the asking price is fair.
What about internal use?
Companies do in-house valuations too, maybe for tracking asset values, strategic planning, or thinking about selling off a division. Then there are more specific things like valuation opinions, fairness opinions, assessing if deal terms are fair to shareholders, for instance.
And sometimes less detailed ones.
Right? Like calculation engagements, which are more limited in scope, or valuation reviews, where one valuer checks another's work.
And does the reason for the valuation change how it's done?
Oh, absolutely. The purpose can definitely influence the choice of method, maybe even the final value conclusion.
How so?
Well, take a company planning to sell itself. The valuers they hire might get access to detailed internal forecasts, right? Making an income method like DCF a really strong candidate.
Whereas a buyer wouldn't have that inside track.
Exactly. So the buyer might lean more heavily on market comparisons, on what similar companies are trading at.
Independence seems absolutely critical here for the valuation to be credible. What's the valuer's role in ensuring that?
Independence and objectivity are paramount. Valuers have to do thorough research, digging into company data, industry reports, market info, all from reliable sources.
And be upfront about it.
Totally. They need to be transparent about where the information came from and clearly separate objective facts from their own professional judgments or opinions.
Like when picking comparable companies for multiples.
Perfect example. Selecting that peer group for market multiples isn't just a quick search. It demands a well-reasoned, consistent methodology to make sure the comparisons actually hold water. You can't just pick ones that give you the answer you want.
So what are some basic things that absolutely have to be in a valuation report?
Well, a good report should always disclose any potential conflicts of interest the valuer might have. Do they rely on other experts? That needs to be stated too.
And tailor it to the audience.
Yes, definitely. It needs to fit the client's needs. An internal management report might look different from one prepared for, say, a court case or a big public transaction that regulators might scrutinize. And it must clearly state who is intended to rely on the valuation.
Are there situations where a valuer should just say no to an assignment?
Yes, absolutely. They have a professional responsibility. If the fee is so low it compromises the quality of the work, or if the deadline is just completely unrealistic for the complexity involved,
They should walk away.
they should decline the engagement, yeah. Quality has to come first.
You mentioned different kinds of info. What data types do valuers typically work with?
Broadly, internal and external. Internal data comes from inside the company, financials, business plans, sales figures, management reports.
And external.
That's from outside industry stats, economic forecasts, data on comparable companies, market research. The IVS really emphasizes checking the credibility and reliability of all data used.
Can't build on shaky foundations.
Exactly. If information seems dodgy or can't be verified, it shouldn't be the basis for the valuation.
How important is it for the valuer to really get the business itself beyond the numbers?
Oh, it's fundamental. You can't accurately predict future cash flows or pick the right valuation methods without a deep understanding of how the business actually operates, its strategy, its competitive advantages.
So looking at past financials is part of that.
Absolutely. Analyzing past performance trends and profit, earnings like EBITDA and EBIT, debt levels is crucial. But, and this is a big but, you have to remember that past performance isn't always a guarantee of future results, especially if the business model, the leadership, or the overall strategy has changed significantly. History is a guide, not a crystal ball.
When we look to the future, assumptions seem unavoidable. How are those handled?
Any significant assumptions underpinning the valuation have to be clearly stated and explained. What are the key drivers? Why were they chosen? This might include hypothetical assumptions about uncertain future events, but they need to be consistent with the valuation's purpose.
Like the cash flow projections in a DCF.
Exactly. Those projected cash flows need to be reasonable. Do they align with the company's characteristics, its market position, its financial health, its historical performance? You can't just pluck numbers out of thin air.
Are there specific standards or guidelines that valuers generally follow?
Yes, there are. Various valuation standards and guidelines exist, and their influence has definitely grown. Organizations like the International Valuation Standards Council, the IVSC, are working towards globally recognized best practices.
A common language for valuation.
Kind of. While different regions or professional bodies might have specific rules, there's a general trend towards harmonization, towards agreeing on core principles. These standards provide a framework for doing valuations consistently and professionally.
So it's definitely not just about plugging numbers into a formula then.
Absolutely not. That's a common misconception. Business valuation is much more of a thoughtful process. It integrates different pieces of information, different perspectives, to arrive at a well-supported, consistent estimate of value.
The model is just a tool.
Precisely. Choosing the right inputs, the right parameters, the assumptions that make the model actually reflect the business, that's the critical part. Technical skill matters, but that integrated analysis of the firm is indispensable.
And does it matter who owns the company?
Oh, definitely. Valuing a small, privately held company with just a couple of owners might need a different approach than valuing a huge, publicly listed corporation.
Like family businesses.
Yeah, family dynamics can play a role. Plus, things like shareholders' agreements can impact control, who has it, and whether you need to apply things like control premiums or discounts for minority stakes.
Okay, great groundwork. Now let's actually dig into analyzing the business. What key internal things does a valuer need to scrutinize?
All right, internally, we look at both tangible and intangible assets. Tangible assets are the physical stuff, buildings, machinery, equipment. We need to assess their current market value, considering wear and tear, depreciation, not just what they cost originally.
And the intangibles, the non-physical stuff.
Right. Things like brand loyalty. Do customers keep coming back? Pricing power. Can they charge a premium? Bargaining power with suppliers. And crucially, the potential to leverage that brand into new areas, new products, brand extension potential.
You mentioned adjustments earlier. Can you give a quick example again of why that's so vital?
Sure. Let's say you're valuing a small local craft brewery. If you just took the average valuation multiple, say EBITDA, from big global brewers like Anheuser-Busch, InBev, or Heineken.
They get a crazy number.
Exactly. You'd likely get a wildly inflated value. You absolutely have to adjust for the huge differences in scale, brand recognition, market reach, distribution power, diversification, risk profile. The list goes on.
Okay, so understanding the inside is crucial. What about the world outside the company? How does a valuer analyze that external environment?
Getting the industry right is step one. Is it growing, mature, declining? That sets the context. But defining industry boundaries can be tricky.
Like your Apple example, tech, music, phones.
Precisely. Is Apple just a computer company? No way. It spans multiple industries, each with its own dynamics, benchmarks, and competitors. Putting a company neatly in one box is often way too simplistic.
And industries change, right?
Constantly. So valuers need to look at the big picture macroeconomic trends, local conditions, then zoom in supply and demand forces, the company's competitive positioning, R&D investment levels, who the main rivals are, and what they're up to.
Technology shifts too.
Huge factor. How might technological changes disrupt the industry or create new opportunities? That needs to feed into future projections, especially for longer-term valuations.
You used the term professional skepticism before when looking at company data. What does that look like in practice?
It means not just taking the information you're given at face value. A valuer needs to critically evaluate it, ask questions. Does this make sense?
Challenge assumptions.
Exactly. Be prepared to challenge assumptions and propose changes if the data doesn't seem realistic or representative. If a business plan shows, say, revenue doubling next year with no explanation of new investment or market shifts,
Red flag.
big red flag. A skeptical valuer digs deeper. The projections need to be consistent with the company's history, capabilities, and the market reality.
It sounds like the different valuation approaches we talked about, income, market, cost, they might highlight different facets and could lead to different answers sometimes.
That's a really sharp observation. They absolutely can. A DCF focusing on future free cash flow might give a different picture than an EBITDA multiple, which is more about current operating profit.
Temporal misalignment, maybe?
Could be, or just different perspectives. If there are inconsistencies, or if one aspect is stronger than another, the values might differ. And importantly, no single approach is inherently superior. The best choice depends on the specifics. What data is reliable? What question are you trying to answer?
What if you're valuing a company in a place where accounting isn't standardized or information is scarce?
That definitely adds complexity. Valuers have to work with the best available information, be very transparent about the limitations in their report, and perhaps rely more heavily on methods that are less sensitive to detailed accounting data.
And the purpose matters again. IPO versus valuing a small private stake.
Yes, the purpose guides the approach. An IPO valuation will likely demand more rigorous, multifaceted analysis than valuing a minority interest where control isn't a factor.
So it feels like the goal isn't finding the one single correct value, but maybe the most well-supported or consistent value range.
That's a great way to put it. Consistent is a good word. A business's assets exist to generate a return, an ROI. That ROI needs to make sense given the business model, management skill, industry, market position, all that stuff.
And that return needs to cover.
It needs to be adequate to compensate the shareholders for their risk, that's the cost of equity, and the lenders for providing debt, the cost of debt.
Which brings us back to WACC.
Exactly. If a company consistently generates an ROI that's higher than its overall cost of capital, it's WACC.
It's creating value.
It's creating value. Simple as that, conceptually.
And that also helps explain why a company might show short-term losses but still be considered valuable, right?
Absolutely. Think about Amazon in its early days, or many tech startups. They might lose money for years while investing heavily in growth, building market share, developing technology.
The market sees the long-term potential.
Right. The losses were strategic investments. Short-term profitability isn't the only measure of value creation, which is fundamentally a long-term game.
Okay, let's pivot now to a more detailed look at the numbers. Financial statement analysis. Why is this so critical for valuation?
Analyzing past financial statements, the balance sheet, income statement, cash flow statement, is absolutely fundamental. It gives you the track record. It helps you sanity check future projections. Are they consistent with history? And it guides you in picking the best valuation method.
Well, what insights do you get?
You learn so much. How does the company manage its investments versus its financing? Can it pay its bills? How much actual cash does it generate? Is it profitable relative to the capital invested? How efficient are its operations? It's like the company's financial DNA.
What are the main sort of technical steps involved in this analysis?
Two key substeps. First is reclassification. Companies use different terms, different formats. Accounting standards like IFRS versus GAAP can differ. So you reclassify the statements into a standardized layout.
To compare apples to apples.
Exactly. Makes it easier to compare over time and against peers. And it's not just mechanical. You need to understand the accounting nuances, maybe even bring in relevant non-financial info for context.
And the second step?
Selecting suitable financial ratios. Ratios help you quickly assess key areas. Liquidity, can it pay short-term bills? Solvency, the balance between investment and financing, and profitability.
But it's not just calculating ratios, right?
Yeah.
It's about interpretation.
Absolutely. The numbers themselves don't tell the whole story. You need to interpret them. What do they mean in the context of this specific company, this specific industry? You need to establish logical links between the financial figures and the non-financial realities of the business.
How do you actually use these ratios once you have them?
Comparison is key. Two main ways. First, compare the company's ratios over time. That's time series analysis. Look for trends, usually over 3 years or a business cycle. How has performance changed?
And the second way.
Compare them to other companies. That's cross-sectional analysis. You need truly comparable companies, though similar industry, geography, size, business model, even governance sometimes.
So a 5% profit margin means different things in different contexts.
Totally. 5% might be stellar for a grocery chain, but concerning for a software company? Context is everything. History matters too. Was 5% achieved during a boom or a recession?
Fedzini mentions functional reformulation of the balance sheet and income statement. What's the point of that?
It's about rearranging the statements to give a clearer view of operations versus financing. The functional balance sheet separates operating assets and liabilities from financial ones, and also splits things into current versus non-current. It helps you see the core business structure more clearly.
And the income statement.
Similarly, it restructures the income statement, often starting with gross margin and showing how that gets distributed, covering labor, depreciation, interest, taxes, dividends, and finally leaving net income. It highlights operational profitability.
And the cash flow statement fits in how?
The cash flow statement is crucial. It bridges the balance sheet and income statement. And importantly, it's often seen as a more neutral measure of performance because it's less affected by accounting choices and policies. It shows the actual cash moving in and out. That's hard to fudge.
Let's focus on profitability. What are the key metrics valuers use?
Well, profitability shows if a company can generate profits sufficient to cover its costs and reward its investors. There's no single right level. It depends on risk, industry, financial structure, asset quality, etc.
So what do you look at?
Key ratios include return on equity, ROE, that's net income, versus shareholders' equity. It shows the return shareholders are getting on their investment. Then there's return on investment, ROI, often EBIT versus business assets, and return on assets, ROA, net income versus total assets.
ROI and ROA are more asset-focused.
Right. They measure how effectively the company uses its total investment base to generate profit before considering how it's financed. Ideally, these returns should be higher than the WACC.
So ROE is the shareholder view, ROA is the total business view.
Exactly. ROE tells you the return on the owner's slice. ROA tells you the return on a whole pie, the total capital invested in the business assets. A 12% ROE is great for shareholders, but ROA answers a different question about overall asset efficiency.
What about profit margins? We hear about EBITDA and EBIT margins a lot.
Yeah, those are key indicators of core operating profitability. EBITDA margin, earnings before interest, taxes, depreciation, and amortization as a percent of sales, and EBIT margin, earnings before interest and taxes as a percent of sales, show how much operating profit the company makes for every dollar of sales.
Before financing and taxes.
And before non-cash items like depreciation in EBITDA's case. Higher margins generally mean more efficient operations or stronger pricing power.
Okay, moving from profit, a company also needs cash to pay its bills. How do we look at liquidity?
Liquidity analysis checks if a company can meet its short-term obligations. We use ratios like the current ratio, current assets, current liabilities, the quick ratio, which excludes inventory from current assets, and the cash ratio, just cash current liabilities.
And working capital turnover.
That's also crucial for liquidity. How quickly does it collect from customers? Receivables turnover. How long does it take to pay suppliers? Payables turnover. How fast does inventory move?
And ideally, you collect faster than you pay.
Generally, yes. If your collection period in days is shorter than your payment period, you're effectively getting short-term financing from your suppliers, which reduces your need for external borrowing. Efficient working capital management is key.
Negotiating good terms helps them.
Absolutely. Better payment terms with suppliers, faster collections from customers, lean inventory, it all shortens the cash conversion cycle and frees up cash.
What about debt? Companies use it to grow, but too much is risky. How do we assess leverage?
Analyzing the debt-equity mix is vital. There's no single magic number for optimal leverage. It depends on risk appetite, industry norms, collateral availability, but we look at ratios.
Right.
Debt-to-asset ratio shows what percentage of assets are funded by debt. Debt-to-equity ratio compares total debt to shareholder equity. We often compare these to industry benchmarks. Is the company more or less leveraged than its peers?
And matching debt maturity to asset life.
That's an important principle. Ideally, long-term assets, like factories, should be financed with long-term debt, and short-term assets, like inventory, with short-term debt. Though having some long-term sources cover part of current assets provides a nice buffer. An imbalance can create risks.
What about dividends? What do they tell a valuer?
The dividend payout ratio, what percentage of net income gets paid out as dividends, can signal growth prospects. A company paying out a very high percentage might have fewer attractive reinvestment opportunities internally.
So it gives the cash back to shareholders instead.
Right. Compare two firms with the same ROE. If one pays out 80% of earnings and the other only 20%, the one retaining more cash, the 20% payout one, likely sees better internal growth opportunities and might grow faster in the future.
Lastly, in financials, how does an economic crisis typically hit these ratios?
A crisis usually hammers revenues first, making it hard to cover fixed costs, so profitability ratios tank.
Liquidity dries up.
Often, yeah. Current and quick ratios might drop below 1. Inventory becomes critical. Can it be sold? Working capital turnover slows as sales drop and customers delay payments.
And financing options shrink.
Exactly. Borrowing gets tougher. Could be impossible. So the equity cushion shrinks relative to debt, leading to higher debt to capital and debt to equity ratios. It's a tough situation.
Okay, fascinating look through the financial lens. Now let's shift focus to the first big valuation method, the income-based approach, specifically discounted cash flow, DCF.
Right, DCF. It's all about valuing a business based on the present value of the cash flows it's expected to generate in the future. You forecast these cash flows, then discount them back to today using a rate that reflects their risk.
The basic idea being,
a rational investor won't pay more than the present value of the cash they expect to get back over time. The basic formula sums up the present value of cash flows over a forecast period, plus a terminal value representing everything beyond that.
how reliable are those future cash flow forecasts? Predicting the future sounds hard.
It is hard. Reliability really varies by industry. Stable sectors like utilities, maybe more predictable. Volatile tech sectors, much tougher.
Things change fast.
Incredibly fast. Think about how quickly market leaders can emerge or get disrupted, or how business models shift, like Amazon changing retail or food delivery platforms hitting traditional restaurants. These things mess with forecasts.
You mentioned working capital turnover affecting cash flow. How does that play into DCF?
It's critical because working capital changes directly impact free cash flow, FCF, which is what we usually discount. If projections assume big improvements in collecting receivables faster or stretching payables.
You need to ask why.
Exactly. Are those assumptions realistic? Does the company have the market power or operational efficiency to actually achieve that? And need to verify the assumptions behind those working capital projections.
Hazini talks about two main DCF types, equity side and asset side. Key difference.
Equity side, or levered DCF, focuses on cash flow available to equity holders. Free cash flow to equity, FCFE, after debt payments. You discount this using the cost of equity. It gives you the equity value directly.
And asset side?
Asset side, or unlevered DCF, looks at cash flow generated by the business before debt payments. Free cash flow, FCF, or sometimes FCFF, free cash flow to firm. You discount this using the weighted average cost of capital, WACC, which reflects the cost for all capital providers.
And that gives you?
Enterprise value. To get equity value, you then subtract the market value of net debt. So different paths, different discount rates, usually aiming for a similar equity value endpoint.
We keep saying discounting. Why is that so central?
Time value of money. It's fundamental. $1 today is worth more than $1 promised next year.
Because you could invest it.
Exactly. You could invest today's dollar and earn a return. So to compare cash flows across different time periods, we discount future flows back to their present value using a discount rate.
And that rate reflects risk too.
Yes. The discount rate accounts for both the time value and the riskiness of receiving that future cash. Higher risk means a higher discount rate, which means a lower present value. It has to be tailored to the specific investment's risk profile.
A key part of that discount rate, especially for cost of equity, is the CAPM capital asset pricing model. Can you break that down?
Sure. CAPM is a very common model for estimating the cost of equity. Key, the return investors expect for holding a stock, given its risk. The formula is basically key equals risk-free rate, RF, plus beta times the equity risk premium, ERP.
Okay, let's unpack that. Risk-free rate, RF. What is it? Where do we find it?
Theoretically, it's the return on a zero-risk investment.
Yeah.
In practice, we usually use the yield on long-term government bonds from a stable, highly rated country.
Like U.S. Treasuries or German bonds.
Exactly. But it varies. Greek government bonds have a higher yield than German ones because there's more perceived risk. So the RF depends on the country's creditworthiness.
And you match the bond maturity.
Ideally, yes. Match the bond maturity roughly to the valuation's forecast horizon. And consider geographic relevance. Where does the company operate? Where does it generate value? U.S. Treasury yields are often a global benchmark.
Okay. Next component, beta. What does that tell us?
Beta measures a stock's volatility relative to the overall market. It quantifies systematic risk, the risk you can't diversify away.
So a beta of 1.
Means the stock tends to move in line with the market. Greater than 1, it's more volatile. Less than 1, less volatile. Negative beta is rare, meaning it moves opposite the market.
Fitzini distinguishes raw beta and adjusted beta. What's that about?
Raw beta is calculated straight from historical price data, stock returns versus market returns. Adjusted beta modifies that. It's based on the tendency for betas to drift towards the market average of 1 over time.
So it smooths it out a bit.
Kind of. The formula usually weights the raw beta and the market average of 1, trying to get a potentially more stable estimate for the future.
And then leveled versus unlevered beta sounds trickier.
It's a bit more involved. Levered beta reflects total risk, the business risk, plus the financial risk from debt. More debt usually means higher levered beta.
And unlevered.
Unlevered beta tries to strip out the effect of debt, isolating just the underlying operating risk of the business itself.
Why do that?
It's useful for comparing companies with different debt levels. You can find the unlevered beta for comparable public companies, representing industry operating risk, and then relever it based on your target company's specific debt-to-equity ratio and tax rate. It tailors the risk measure.
So you adjust for the target-specific financial structure.
Exactly. Fitzini provides the formulas for unlevering and relevering. It's a standard technique, especially when valuing private companies using public comparables.
What about companies with multiple business lines?
That gets complicated. Ideally, you'd find comps for each segment, get their betas, and calculate a weighted average beta. But that needs segmented financial data, which isn't always easy to get. Fitzini also mentions APT, arbitrage pricing theory, as a more complex alternative to CAPM.
Okay, last APM piece. Equity risk premium. ERP. What is it?
ERP is the extra return investors demand for investing in the stock market overall, compared to risk-free assets. It's compensation for taking on that general market risk, plus some company-specific risk elements captured by beta.
How do analysts estimate the ERP?
Several ways. Looking at long-term historical averages, the difference between past stock market returns and government bond returns, or modifying those historical averages, maybe adding a country-specific risk premium.
Forward-looking methods.
Yes, the implied ERP tries to figure out the market's expected return based on current prices and future dividend expectations. Often, valuers rely on published ERP estimates from data providers like Duff & Phelps, now Kroll, or Damodaran.
But you need the right country's ERP.
Crucial point. Is it where the company is HQD, where it trades, where it makes its money? Might need an average sometimes. It's a key judgment call.
So CAPM RF plus, beta ERP, are there other adjustments sometimes made?
Some argue CAPM doesn't capture everything, especially for smaller or private firms. You might see a smaller stock premium, SSP, added, based on historical small-cap outperformance, or a company-specific premium, CSP, for unique, uncaptured risks.
But those are subjective.
Very. While the idea makes sense, quantifying them reliably is tough. Fitzini advises caution adjustments need strong justification. Ideally, specific risks should be reflected in the cash flow forecasts themselves.
Makes sense. Now, the other WACC component, cost of debt. How's that calculated?
Cost of debt is the return lenders require. We usually use the after-tax cost because interest payments are typically tax-deductible, creating a tax shield.
So the formula is?
After-tax cost, pre-tax cost, one tax rate. The pre-tax cost is basically the risk-free rate plus a credit spread reflecting the company's default risk.
How do you find that spread?
If the company has a credit rating, you use the typical spread for that rating. If not, you might estimate a synthetic rating based on financial ratios like using Altman Z-score models and use the corresponding spread. Then apply the tax adjustment.
Okay, finally, combine cost of equity and cost of debt into the WACC. How?
WATCC, weighted average cost of capital, is the average cost of all the capital, weighted by proportion. You take the cost of equity times the percentage of equity in the capital structure, plus the after-tax cost of debt times the percentage of debt. Add them up. That's your discount rate for the asset side DCF.
Got it. Now, back to the DCF calculation itself, that terminal value thing. What is it, and why is it such a big deal?
Terminal value TV represents the value of all cash flows beyond the explicit forecast period, usually 3 to 5 years. Since you can't forecast forever, TV captures the remaining value, assuming the company is a going concern.
How is it calculated typically?
Often using the perpetuity growth model. Assumes cash flows grow at a stable, constant rate forever. Formula is roughly cash flow year N plus 1. Discount rate, long-term growth rate. N is the last forecast year.
And that long-term growth rate, where does that come from?
It should be a sustainable long-run rate, typically no higher than the expected long-term growth of the overall economy or maybe the industry, often linked to inflation. It can't be unrealistically high forever.
Fazzini notes TV can be huge, like 60–90% of the total DCF value. Why?
Because it represents the present value of an infinite stream of future cash flows, even if they're only growing slowly. If your explicit forecast is short, TV naturally captures a bigger chunk of the total value.
Makes the assumptions critical.
Hugely critical. Small changes in the discount rate, or especially that long-term growth rate assumption, can swing the total valuation significantly. Sensitivity analysis is key here.
Are there other ways to estimate terminal value?
Yes. The exit multiple method is common too. Instead of assuming perpetual growth, you estimate what the company might sell for at the end of the forecast period by applying a market multiple, like EBITDA, to its projected year-end performance.
You mentioned asset side and equity side DCF might give slightly different results. Why, and which one to use?
Differences can pop up because they use different cash flows, FCF versus FCFE, and different discount rates, WACC versus key. The underlying calculations and timings aren't identical.
So which is better?
No single answer. It depends on the situation. Equity side might be more direct if you only care about equity value.
Yep.
Asset side is often preferred for analyzing operational value independent of financing, and it's common in M&A. Consistency in assumptions is key. Choose the one that best reflects the situation.
Lastly, on income methods, the dividend discount model, DDM, how does that fit?
DDM is another income approach, but it values stock based on the present value of expected dividends per share, not free cash flow. Logic is similar. Value comes from cash return to owners.
So you forecast dividends?
Yeah, you forecast future earnings per share and the dividend payout ratio, then discount the expected dividends using the cost of equity. There's also a perpetuity growth version for dividends, similar to the DCF terminal value, using key, and an expected dividend growth rate, often linked to ROE and the retention ratio.
Okay, great overview of income methods. Let's switch gears to the market-based approach using multiples.
Right, the market approach. Valuing a company based on what similar companies are worth in the market, either their trading multiples or prices paid in recent deals. It's very common, often seems easier.
But potentially superficial.
That's the risk Fazzini highlights. You can't just grab a multiple and apply it blindly. Are the comparable companies truly comparable? Is the data reliable and recent? Are there significant differences that need adjustment? It requires careful thought.
Finding genuinely comparable companies sounds like the hardest part. What makes them comparable?
It's multifaceted. Same industry as a start, but not enough. You need similar business activities, similar size, revenue, assets, employees, similar profitability levels, margins, ROE, similar financial structure, leverage, similar growth prospects.
Geography matters too.
Definitely. Geographic scope, national versus international. Competitive positioning. Even maturity stage. Are they pure play or diversified? And the timing of the multiples, trailing, forward, current, it's a detailed checklist.
You used the food and beverage example before to show industry variation.
Exactly. Even within food, a high-end organic brand is vastly different from a commodity processor. Their margins, risks, growth, and thus their multiples will differ significantly. Fazzini's tables show this wide dispersion. You need a tightly defined peer group.
What are the main types of multiples used?
Two main buckets. Equity multiples and asset side or enterprise value multiples. Equity multiples relate market cap equity value to equity metrics. Think price to earnings, PE, or price to book value, PBV.
And asset side.
Asset side multiples compare enterprise value, total value operations to unlevered performance measures. Things like EV sales, EBITDA, EVABIT, EV free cash flow.
PE is probably the best known. Strengths and weaknesses.
Popular because it's intuitive and widely quoted price per dollar of earnings. But it's sensitive to accounting policies affecting earnings, and useless if earnings are negative or tiny. Fazzini links it back to the DDM, showing it depends on payout ratio, growth, and risk, cost of equity. PEG ratio tries to adjust for growth, but estimating growth is tricky.
Why use asset side multiples like EV sales or EBITDA then?
They're often preferred because they look at the whole business value relative to operating performance before financing effects, interest, and taxes. Makes comparisons cleaner across companies with different debt levels or tax rates.
EV sales useful when?
Good when earnings are negative or volatile, maybe for early-stage companies. But it ignores profitability. Two firms, same sales, vastly different margins. EV sales won't show that.
EBITDA seems very common.
Very widely used.
Yeah.
EBITDA is a proxy for operating cash flow before capital structure and certain accounting choices, depreciation and amortization. Good for comparing core operational profitability.
In EBITDA.
Includes depreciation and amortization, so it's after reflecting capital intensity to some extent, but more exposed to accounting policy differences in depreciation. EV free cash flow relates value directly to cash generation, which is objective but can be volatile year to year. Fazzini has a great table summarizing pros and cons.
So the choice depends on the specific companies and what you want to compare.
Precisely. And remember, these multiples aren't fixed. They swing with market sentiment, economic cycles, industry news. Looking at historical multiple trends, as Fazzini does, gives vital context. The 2008 crisis, for example, crushed multiples everywhere.
Okay, so you pick your peer group, choose relevant multiples. How do you actually value the target company then?
Typically, you calculate the chosen multiples for your peer group. Then you look at the central tendency, often the median, sometimes the average, for that peer group multiple.
And apply that to the target.
Yes. Apply the median or average peer group multiple, say 10x EBITDA, to your target company's corresponding metric, its EBITDA. That gives you an initial implied value.
But then you need to adjust.
Critically important. You have to think, is my target truly average compared to the peers? Does it deserve a premium or discount based on specific differences in size, growth, profitability, risk? Blind application of the average multiple is rarely the final answer.
Okay. Income and market approach is covered. Let's move to the third main one, the cost-based method.
Right, the cost approach. This values an asset or business based on what it would cost to replace it with something of similar utility, replacement cost, or to reproduce the exact same asset, reproduction cost.
When is this method most useful?
The IVS suggests it's best when you can actually recreate the asset without major restrictions, and often when the asset doesn't directly generate income in a way that income market approaches can easily capture. Think maybe specialized infrastructure or certain nonprofit assets.
Replacement versus reproduction cost, key difference.
Replacement cost uses current prices and technology to create the same function or utility, adjusting for wear and tear, obsolescence, of the existing asset, generally seen as more objective, more relevant economically.
And a reproduction cost.
That aims to estimate the cost of creating an exact replica using the same materials, design, methods. It can be more subjective and might not reflect current economic value if the original is outdated.
You mentioned obsolescence. What kinds are there?
Three main types. Functional obsolescence. The asset is outdated in design or technology, less efficient. Physical obsolescence, just plain wear and tear. And economic obsolescence, loss of value, due to external factors like market demand dropping or new regulations making it less useful.
How is cost approach used for tangible assets like machinery or buildings?
Often uses replacement cost. Estimate the cost of new assets with the same capacity performance using current tech. Can be done via a detailed method, costing all components, or a trending method, adjusting historical costs using indices. Then you deduct allowances for accumulated depreciation and any obsolescence.
Can you use cost approach for intangibles too? Patents, software?
Yes, sometimes. If you can reasonably estimate the cost to reproduce or replace the intangible. This might include development costs, maybe an allowance for developer's profit or entrepreneurial incentive. But again, you have to consider obsolescence. Is the patent still relevant? Is the software outdated?
Fazzini gives examples like valuing a workforce or software via cost.
Right. For workforce valuation, you might estimate the accumulated costs of recruiting, hiring, and training the current staff. For custom software, estimate the cost to develop similar functionality today, developer time, salaries, etc. But you'd still need to consider if those skills or that software are functionally or economically obsolete.
Intangibles seem increasingly important. How do we value them beyond just the cost approach? Their value often seems much higher than their creation cost.
Absolutely. Intangibles, brands, patents, customer lists, technology are often the main value drivers today, especially in tech, pharma, consumer goods. Sometimes a firm's value is largely its intangible assets. Think Google's search algorithm or a pharmaceutical patent.
Accounting standards reflect this now.
Yes. Rules like IAS 38 and FASB Topic 350 treat intangibles with indefinite lives differently. No amortization. The IVS defines them as non-monetary assets without physical substance that grant rights benefits. Key criteria for recognition are usually identifiability, control, and future economic benefits.
So if cost isn't always right, what other approaches work for intangibles?
The income approach is very widely used. Several specific methods fall under this umbrella.
Such as?
Relief from royalty. premium profits, or with and without, excess earnings method, and the greenfield method.
Okay, let's take relief from royalty first. How does that work?
The idea is if the company didn't own the intangible, say a brand, it would have to pay a royalty to license it from someone else. So the value of owning it is the present value of those royalty payments it avoids making.
So you estimate hypothetical royalties.
Exactly. Project the revenue the asset will generate, apply a reasonable hypothetical royalty rate to that revenue, calculate the implied royalty savings, and discount those savings back to present value.
Finding that royalty rate sounds key.
It is. You look at market rates for similar licenses, if possible, from databases, or use a more subjective split of profits method. You adjust based on factors like competitiveness, asset importance, life cycle stage. And you might add a tax amortization benefit, PAB, for the tax shield owning the asset provides.
Okay, what about the premium profit or with and without method?
This compares the business's projected profits or cash flows with the intangible asset versus what they'd be without it. The difference in the present values of these two scenarios is the asset's value.
Sounds simple, but hard to estimate the without case.
Very hard, especially for core assets like a major brand. How do you realistically model the business without its brand? It's maybe more applicable for things like non-compete agreements where the impact is more isolated.
Next, excess earnings method.
This values the intangible based on the earnings it generates in excess of the returns required by all the other assets contributing to those earnings. Tangible assets, other intangibles like workforce.
So you isolate its contribution.
Right. Forecast total earnings, then deduct a charge or required return for all the contributory assets based on their value. What's left over the excess earnings is attributed to the intangible being valued. You discount that excess earnings stream, often done over multiple periods, MPO.
And finally, the greenfield method.
Greenfield values the intangible by projecting cash flows for a hypothetical new business that starts only with that intangible. It assumes all other necessary assets, plant, equipment, working capital, workforce, have to be bought, built, or rented from scratch.
Similar to excess earnings, but assumes building from zero.
Conceptually, yes. Instead of deducting charges for existing contributory assets, it builds their acquisition rental costs into the cash flow projections of this hypothetical startup built around the single intangible.
Lots of ways to tackle intangibles. Okay, last major topic, premiums and discounts and valuation.
Right. When valuing a specific ownership stake, especially less than 100%, we often need to adjust the pro rata value. A control premium, CP, is extra value paid for a controlling interest, the power to direct the company.
And the opposite.
A discount for lack of control, DLOC, is a reduction applied to a non-controlling minority interest, reflecting its lack of influence over management and policy. The idea is simple. Control is worth something. Minority shares are worth less than their simple fraction might suggest because they lack that power.
What about the discount for lack of marketability, DLOM, especially for private firms?
DLOM reflects the difficulty, time, and cost of selling ownership interest for which there isn't a ready public market, like shares in a private company. It's harder to find a buyer and transact compared to selling public stock.
How big is DLOM usually?
It varies a lot, depends on the company, asset type, cash flow, number of shareholders, but ranges like 15–30% aren't uncommon. Crucially, DLOM and DLOC are separate concepts and should be calculated individually, not just added together.
Are there other discounts or premiums valuers consider?
Yes, NOCVA lists others. Blockage discounts for selling huge blocks of public stock that might depress the price. Key person discounts if the business relies heavily on one individual. Restrictive agreement discounts if share transfers are limited by contracts. And investment or holding company discounts, where the holding company trades for less than the sum of its parts.
Wow, this has been an incredibly thorough deep dive, really covered a lot of ground on business valuation. To wrap up, what are maybe 2 or 3 key takeaways for our listeners?
Okay, first, I'd say remember, valuation is comprehensive. It's way more than just formulas. It needs deep understanding of the business, its industry, the economy, its analysis and judgment.
Right, not just number crunching.
Second, there's no single right method. The best approach depends entirely on the specific situation, the purpose of the valuation, and the quality of available data. Often, using multiple methods gives a more robust picture.
And third,
Understand the difference between theoretical value and actual price, And know that factors like control and marketability can make a specific ownership stake worth more or less than a simple pro rata share of the whole.
Great summary. And for you, our listener, hopefully this deep dive has helped demystify some of this complex world. Whether you're looking at investments, trying to grasp your own company's value, or just aiming for better financial literacy, understanding these core principles is really valuable.
Definitely. We covered a lot, but honestly, this is still an overview. Each method, each concept, CAPM, multiples, intangible valuation, has layers of additional detail and nuance. So if something sparked your interest, definitely dig deeper.
Absolutely. And maybe a final thought to leave you with. We talked a lot about models, data, quantitative analysis, but how much of business valuation ultimately comes down to the valuer's experience, their judgment, maybe even their intuition. And looking forward, how will disruptive tech and constantly shifting business models keep challenging how we even define and measure business value in the future? Something to think about.